Amazon rebounding a bit over the last 3 months, up over 30%, recouping some of the company's losses since the beginning of the year.
Do you think the 2020s is a difficult ride for investors? Pandemics, wars, and financial crises these years are becoming really unpredictable. But as we set our sights on 2024, we're optimistic about the potential for these 5 stocks that can bring substantial returns. Number 5. Visa NYSE-V. Forget about the recent stock market all-time highs driven by big tech, which signaled a new bull market. Visa, a leader in digital payments, recently released another strong earnings report, demonstrating its stability and resilience. Visa began its fiscal 2024, which ended in September 2023, with an 8% year-over-year growth in payments volume. This comes after the company reported a 9% increase in overall payment volume in fiscal 2023, a 12-month period that ended in September 2023. Despite a recession-like economy throughout the past year or so, Visa has proven its strength. In 2024, some experts will still be adamant about calling for a recession and slower economic development, but Visa thinks all is well. It's predicting stable growth in its global payment volume that could lead to revenue growth in the high single-digit to low teens. However, it's important to note that Visa, like any other company, is not immune to economic downturns or regulatory changes that could impact its operations. If you're looking for a quick and easy way to invest in the new bull market, Visa stock could be your ticket in 2024. In order to handle tens of billions of transactions every quarter, 57.5 billion in the most recent quarter, Visa runs 4 of its data centers in addition to a specialized worldwide telecom network. Its primary function is that of a toll booth, collecting a percentage of all transactions made through its network. Number 4. Charter Communications, NSY-CHTR. Charter Communications Incorporated released its first quarter financial results via an 8-K filing on April 26, 2024. The company's $7.66 earnings per share roughly matched the 7.92 consensus forecasts. The $13.7 billion in reported revenue was somewhat more than its $13.74 billion predicted, representing a 0.2% year-over-year increase. This performance indicates that the company is maintaining its financial stability and meeting market expectations. Following the 2016 merger of Time Warner Cable, Bright House Networks, and Legacy Charter, Charter Communications emerged as a significant participant in the telecommunications sector. It provides about 30 million residential and 2 million commercial client accounts under the Spectrum brand. With about 40% of the national market, the company's vast network connects approximately 57 million households and companies in the US, making it the country's second largest cable provider after Comcast. This market share gives Charter a strong competitive edge and a solid foundation for future growth. Customer dynamics showed mixed results in the first quarter, with a minor reduction in internet customers of 72,000 and a solid gain in mobile lines of 486,000. The increase in mobile lines is indicative of Charter's strategic effort to strengthen its mobile services business, which achieved a noteworthy 37.8% revenue increase. Notwithstanding these successes, the business continues to confront obstacles, such as a decline in phone and video subscribers, which is indicative of the broader industry trend toward cord cutting and the uptake of streaming and digital communication options. Charter has demonstrated its ability to adjust to changing customer tastes through innovations like the introduction of internet-delivered streaming TV packages like Spectrum TV Stream and the distribution of Xumo Stream boxes. Next on number 3, we've got Amazon, NSY-AMZN. 2024 has seen Amazon.com get off to a great start, as evidenced by the company's stock rising sharply following its fourth quarter earnings release in February. The strong performance indicates that the company is on track to continue its growth trajectory. Although the IT giant still has a lot of work ahead of it, its first quarter earnings report is about to be released. Analysts following Amazon's stock are looking for signs that the company will continue to boost profitability of its enormous online retail operation, while also fending off competition in the cloud computing space. Among the most valuable firms in the world, Amazon has a market capitalization of more than $1.8 trillion. The Seattle-based business just outperformed its 2021 record-high share price, but Walmart and Target are putting up more of a fight on it for digital sales. It is currently competing with Microsoft to become the top cloud platform for AI that is generative. Amazon leads the industry in both cloud computing and e-commerce thanks to its AWS business, Amazon Web Services. The corporation has resorted to AI and a flourishing advertising industry to accelerate its expansion. Amazon is still far over its last legitimate buy point though. Furthermore, the operator of the so-called Everything Store is facing a significant antitrust lawsuit from the US government. These factors could potentially impact the company's stock performance and should be considered when making investment decisions. So, is Amazon a good buy? According to FactSet, Amazon's overall revenues are predicted to rise by 12% to $142.6 billion. Analysts anticipate a 170% increase in earnings per share, or 84 cents per share. Additionally, analysts predict that AWS will see a 15% year-over-year rise in revenues, or $24.56 billion in revenue. This contrasts with the December quarter's 13% growth. For the first time since the fourth quarter of 2021, the cloud computing segment would experience faster growth for 2 quarters in a row. Companies started to spend less on the cloud in 2022. Microsoft, Amazon Cloud's rival, and Alphabet, Google's parent company, both released impressive quarterly numbers before Amazon did. Microsoft reported that the growth of its Azure cloud business in the March quarter was 31% year-over-year, up from 30% growth in the previous quarter. On the other hand, Alphabet reported that cloud revenue increased by 28% year-over-year, up from 25% in the December quarter. This comparison can help investors gauge Amazon's competitive position in the market. Brad Reback, a Stifel analyst, wrote to clients, citing AI and a greater demand for cloud computing as the reasons for both Microsoft and Google's better performance. The final piece in the 1Q consumption puzzle will be AWS's results and commentary, he stated. Amazon's advertising business also bears watching. Digital ads are again projected to be Amazon's fastest growing division in the first quarter. According to FactSet, analysts project sales will increase 23.5% year-over-year to $11.74 billion. Wedbush analyst Scott Devitt wrote in a recent Amazon earnings preview that he is looking for sustained advertising momentum, accelerating AWS growth, and continued margin improvements for Amazon's North America and international retail divisions. Jassy praised the technology's potential and Amazon's emphasis on generative artificial intelligence in the letter. With its investment in AI, Amazon stocks will surely see new highs. Number 2. Microsoft. Microsoft's stock has gained nearly 70% since the start of 2023, as compared to the 30% rise in the S&P 500 index over the same period. At its current price of just above $400 per share, it is trading 4% below its fair value of $419. Trefis estimate for Microsoft's valuation. Amid the current financial backdrop, Microsoft's stock has seen extremely strong gains of 80% from levels of $220 in early January 2021 to around $400 now, versus an increase of about 30% for the S&P 500 over this roughly 3-year period. And now, number 1 is the most bought stock. we have Google. Google delivered a Q1 2021 earnings report so strong that it drove the company's stock to an all-time high valuation. It came during after-hours trading following the news that Google had beaten both revenue and earnings per share expectations. Google's stock shot up after markets closed this afternoon following the publishing of its Q1 2024 earnings report. The stock's value peaked at $181.90 at around 5 p.m. ET in after-hours trading. This represents an all-time high for the stock. In addition to beating its expectations for revenue and EPS, Google also saw YouTube generate $8 billion in ad revenue during the quarter. The company also announced a quarterly cash dividend policy alongside its earnings. Alphabet, the parent company of Google, surged on March 18th after Bloomberg reported that Apple is in talks with the Google parent over licensing its Gemini artificial intelligence training model for use in iPhones. We hope you found this information valuable. If you did, show your appreciation by hitting that like button below. And to never miss any future content from us, don't forget to subscribe and ring that notification bell. Until next time.